If you want to trade like a rebel, you got to come to Rebelcon 2022. It's going to be in Dallas, Texas, at the fabulous Four Seasons Resort. It will be more fun and more live trading than we've ever done before. That's why it's called Rebelcon 2022. We're going to have barbecues and double the amount of live trading. The guest speakers, as soon as we announce those, this thing's going to be sold out, limited to 250 people. Sign up now for Rebelcon 2022 at the Four Seasons in Dallas, Texas.
Welcome to the Rebellion.
Hello, Market Rebels. Well, we did it again, made it through another wild week on Wall Street. And actually, starting from last week, from about Wednesday, we powered up through the 50-day moving average on the SPY. S&P 500 looked like we might be rallying, pulled back, couldn't quite do it. And then starting on Wednesday of this week, after the Fed announcement, we've been screaming higher. Looks like we were finishing up, last I looked, roughly about 1.5% up on the SPY. But again, it just points to so much volatility in the markets. And those are some of the things that we are doing here on Trading Tune-Up. Give you some ideas, trading ideas, tips, strategies, all kinds of things to help you make better decisions with your trading. Now, up to this point for the last couple of weeks, we've been talking about vertical spreads, looking at different aspects of them. Yesterday, I showed you a use for a vertical spread that most people don't consider for those who do a covered call. And so instead of selling a call against shares of stock, you could consider selling a vertical spread. And we looked at what that would do to your risk graph. Well, once you understand vertical spreads, you're going to find that they are incredibly invaluable tools, not only just as strategies by themselves, but as hedging tools. And partly because they're fairly simple, just long and a short option. We can do bullish and bearish. We can use it to offset deltas. There's all kinds of things we can do. We can break them apart. We can assemble them together, different morphing techniques. But what I wanted to show you today was something that I think most people are unfamiliar with, and that is using vertical spreads as a hedge against straddles. Who would have thought? So in volatile markets, a lot of traders or going into earnings season will use straddles. I'm not saying it's a good idea. There's some volatility issues there, but a lot of people do. And unfortunately, they don't know how to hedge them. And so what happens? They put on this fairly expensive straddle, they get up just a couple of bucks, and then they close it. And the problem is you end up taking a boatload of risk and not getting any profit from it. But that's what happens when you don't know your options. So let's take a look at one of the choices you have if you are trading straddles. So today, selling vertical spreads against straddles. And of course, we're going to find out you can work it in the other direction by buying the vertical spreads. So let's start off with a quick definition of a straddle. I think most everybody on here is at least somewhat familiar with a straddle, but it is a strategy where you are going to buy a call and a put with the same strike and expiration. So for instance, you might buy the $100 call, let's just say it's trading for 5, and you buy the $100 put, also trading for 5, and let's say they both have August expirations. Now, for some of you who are a little more astute with your options pricing will recognize if these are at-the-money options that the call should be trading for a little bit more than the put. Actually, that would be true even if they're not at the money. But just to make it simple, I'm going to keep them the same. So they're both trading for 5. And we would say in the business that you are long the $100 straddle for 10. The 10 is just the net premium that we paid for the two positions. Our maximum loss is the amount paid, although as a little side note, the chances of losing the maximum on a straddle they're pretty slim because the stock would have to close at exactly 100.00 to lose that maximum. Chances are you're going to be somewhat off of it, but just for the sake of the argument, that is the absolute worst that could happen. Maximum gains, however, are unlimited. And better yet, we can make unlimited gains in either direction. And this is the real appeal for new traders who first learn about the strategy. They go, oh, the straddle makes money in any kind of market. Well, that's not really true. It might generate deltas, but it doesn't necessarily mean it's generating profits. Those are two different things. But again, this is the real lure for a lot of new traders. They say, I can make money whether the stock goes up or down. So if we buy this straddle right here, the $100 straddle for 10, this would be the risk graph. So we can see we've got these nice unlimited positive deltas over here to the right, and we've got these nice unlimited negative deltas over here to the left. The problem is that we get very wide break-even points. And the reason is that you are effectively buying a call for the price of a call and a put, and you're effectively buying a put for the price of the put and the call. Why? Because at expiration, only one of those can expire in the money. And that means that option has to make up for both premiums, not just for the one option. So it becomes pretty hard to generate profits. Okay, so we've got this very wide break-even points in here. And the way that we figure that out, we take the strike, we add the straddle cost to it, and we subtract it from that strike. So in this example, 100 plus 10 and 100 minus 10. So 100 minus 10 gives us 90 on the low side. 100 plus 10 gives us 110 on the high side. So if you think about that, it's plus or minus 10% in that stock just to break even. And when you consider that most stocks don't even move 10% in a year, that's asking a lot for it. So this is one of the first drawbacks, but this is why you have to understand how to hedge it. But here's the real problem. Let's say that we put this straddle on and the stock starts to move up. It's moving out here to the right, starting to get past this break-even point. And so we're getting all excited. We're going, hey, I'm going to start generating some deltas and making some money. And it comes out here, and then what happens? Now you might have a little bit of a profit, and then what happens? Turns back the other direction. And then as Murphy's Law would have it, it starts falling and falling and falling. And now you've got all this distance to get over here to these negative deltas. So now you're waiting and waiting and waiting. And finally, let's say that we hit these negative deltas and you're going, oh, finally going to start generating a profit. And then what happens? Stock goes back up. And so it's just this back and forth whipsawing, mean reversion at its best. And what happens is that this strategy just slowly bleeds away. We've got, again, this very wide break-even point. So it's this negative theta that is the real detriment of a straddle. Of course, the benefit is the positive gamma and vega. So this isn't really a directional play. In fact, it's a what we would call a neutral outlook, meaning that we don't have an opinion on it, but we are expecting explosive moves. It's really a gamma play. So what could we do here? Well, one thing that some traders will do is they might roll the call or the put out. So let's look at a very simple type of morph. Here's our long 100 call. Here's our long 100 put. We could do a trade where we sell the 100 call and we maybe buy the 105 put. All right, so if we do that, notice when we execute the vertical spread right here, that is selling the 100-105 vertical spread in red. And once it's executed, those two trades cancel. And now we're just left with a long 100 put and a long 105, which is a strangle, kind of the sister strategy. And so we move from this in red, that was the original position, to this. But because we've rolled it, we've also generated a credit. We can start kind of marching this thing up a little bit. But what if we did spreads? And again, this is the big twist that most traders don't think about. They go, well, I'm long an option and short an option, so the only thing I can do is to roll one option at a time. Not true. As we looked at yesterday, vertical spreads have no deltas out in the wings. You can add and subtract those all day long, and in the end, they're not going to do a thing. They just alter the deltas between the strikes. So go back to the original straddle. What if we sold two of the 100 calls and sold 2 of the 105s. So this would be selling 2 of the 100 105 vertical spreads. Look what happens. That leaves us a net of 1 contract on the short side. I've got a short call and a long put. That is, many of you will recognize, a synthetic short position. It's called synthetic because it's not really short stock, but it behaves like short shares of stock. But if we have short shares of stock and we are long 2 call options at 105, what does that do? Well, again, you should be able to picture this stuff in your head. Here is the short stock position. If I bought 1 105 call, I would do that. Right? I would put a bend at 105. That would be a synthetic put. But when I buy the second one, I bring the deltas up, and look at that. It's a 105 straddle. So this shows that we can move that strike. We can recenter this straddle as the stock moves. And this is the real benefit. So that we don't have this problem of the stock going up and coming back down. We have potential profits that we just never make. So let's go back here to the original position. This was our 100 straddle for 10. And if I sell, let's say, the 100 105 vertical spread twice, I can march it up this way. Now, this is what we would look like at expiration. Prior to expiration, probably not going to be the full $5. But what's happening here? We are inviting a 5-point loss, right? Because it's a credit spread, but we're selling it twice. And because this is an in-the-money spread, it's probably trading for at least 350 or so. We'll talk about premiums and discounts in a future class. So I might collect 7 in exchange for a $5 liability. That's a net gain. And that's what's causing this curve to shift up. But again, the main point is that I've recentered it. So now if the stock ticks up just a little bit to the right or just a little bit down, I've got these deltas waiting for it on either side. All right, so that was our first position, minus 10. And right now in this graph, we are up at minus 5. So we are shifting the curve higher as we shift the strike. And we're doing it all with vertical spreads. So again, this is the big point. This is where our stock is right now, or roughly. And notice that if we were on the red curve, we would be to our benefit if it continued higher, but it's going to cost us if it falls, what I showed you in one of the earlier slides. And this is why most traders just end up shutting it down. But now you have a way to recenter and collect some gains, but stay in the position. What happens if the stock continues higher, like we saw this week? Well, we can do the same trade again. Let's sell 2 of the 105s and sell 2 of the 110s. That is selling 2 of the 105 110 vertical spreads, credit spread. What happens? Those cancel, and I'm left with a synthetic short with 2 at the 110 strike. Again, it's going to be a straddle. So because it's a net credit, I'm going to end up marching this up, but I've recentered at 110. And so this allows me to always keep a real advantageous position because I'm always lined up right there with the stock. Okay, so that was the initial position, and now look where we are. At expiration, that's collecting 10. Now, okay, so again, that's the point of that, is just to show that we are recentered. If we were still in the original position down here in red, and the stock's at 110, you're going, oh, gosh, if that stock continues higher, it's going to be great. But if it heads down, those are losses. I'd better close it. That's what traders feel that they should do. And it's unfortunate because they end up taking so much risk for so little reward. And that's just a bad trading plan. You want to learn how to stay in the position. So let's now go in the other direction. What would happen if the stock price falls? So here we are. We've rolled up here to the 110. If the stock goes the other direction, we're just going to unwind it. I'm going to buy 2 of the 110s and sell 2 of the 110s and buy 2 of the 105s. Now we're buying the 105 110. So this is going to cost us money, but remember, it's now an out of the money spread. It might be trading for $2 times 2 would be 4, but I've reduced my liability by 5. So that's a bonus to me. So I've picked up 5 at the cost of 4. It's still shifting me up, but realigning my center of my straddle. Okay, so those go out, and we're right back with a synthetic short and 2 calls. So now we've gone from the green to the black. So it doesn't really matter if the stock price is going up or down. Now, of course, we could get a lot more involved if we wanted to look at the put side, and depending on what's happening, we could also incorporate the puts. But this is just at least a fairly simple look at using vertical spreads as a hedging tool. It's a wonderful, wonderful tool. So for those who might not be too familiar with spreads, you definitely want to learn your verticals. They're great strategies by themselves, but hopefully, as I've shown you here, they are incredibly powerful hedging tools. Now, for next week, I want to give you a little puzzle. This is one that I've often taught in finance classes to test your savvy, and it's going to show you how we can use these to hedge, and especially with strangles. It's a little bit of what's working here as well. But here's the puzzle. Two guards are facing in the opposite directions, yet they can see each other. And so the question for you this weekend, how do they do it? And no, there are no mirrors involved. That's one of the first answers I get. Okay, facing in opposite directions, yet they can see each other. And once you can put this puzzle together, you'll now understand when we get to the iron versions and some of what are called the gut iron versions of some of the strategies. And we're going to look at that on Monday. So I hope to see you then. In the meantime, for anybody who finds this really interesting and says, hey, I could use this for my own trading, we'd like to offer you a free 30-minute one-on-one consultation with one of our world-class coaches. Phone number right there for you, 888-809-8058. Give them a call today. They'd love to have a chat with you and figure out your trading styles, your strategies, and show you tips like this that can put money in your pocket. Okay, the education is where it's at in this game, trust me. And so those are some of the things that we're going to be working on in Trading Tune-Up. So please join us and let everybody know. We'll look for you Monday, Thursday, and Friday, 4 p.m. Eastern Time. I want to wish everybody a happy weekend, and we will see you next week.